That's kind of where I'm at with silver, a kind of a $200 target. I plan to sell all my miners somewhere between $6,800 gold and $7,800 gold. I do not expect to own any miners at $8,000 gold. You don't want to sell tops. You don't want to wait for tops because you just don't know when they're going to come. And when they come fast and furious. $7,200, $7,300 gold, I'll have sold probably half of my stuff. So anything like the West does, they can't put that pressure on China and India. China and India, they're going to keep buying silver, period. So we could run out of silver. Okay, if we run out of silver, then what? We don't know. It's uncertainty, right? What does the government do? Do they prevent us from buying silver? Do they tax it? Silver could go to 150, 180. And then turn around and go all the way back down to $80 and stay there for 3 months. Gold isn't even close to a critical mineral, right? Silver's a critical mineral, and there's not enough of it. If you look at above ground supplies, as a matter of fact, right now the COMEX has like 80 million ounces in registered. LBMA and the Shanghai, those are the only three places where you can buy silver. Over 200 million ounces a year is needed just for solar alone. So gold and the S&P 500 have been basically, I think, in this battle of who's going to win. They're both basically near all-time highs, although gold's 16% from its all-time high, about 4,850, and its all-time high is 5,600. So it's about 16% away, and the stock market's only 1% away. But every time, in the last 2 years, every time gold corrected, it turned around and ripped back for an all-time high, which I think it'll do again. So they're in this battle of who's going to win, who's the winner. Normally, they don't both win. Normally, one does well and the other does poorly. They're cats and dogs. They do not get along. And so which one's going to be the winner? And I think that at 5,500 is the numbers where that's where the battle is going to be fought. So it's going to be 5,500 on the S&P, and we're at 6,900 today, 68, almost 6,900. So it's got a long ways to go all the way down to 5,500. And gold, I think 5,500 on gold, though that's where you're going to get the decoupling. So when they're both right around 5,500, now we probably are going to see 5,800 on the S&P and 5,000 on gold. So gold will be down and about 600. And then gold will start rallying. And right at 5,500, that's where they'll crisscross.
Sometimes the market looks strongest right before leadership quietly changes underneath it. As Durrett points out here, the unusual part is not that gold and stocks are both elevated, but that they are moving toward the same psychological level from opposite directions. When the S&P sits only 1% below highs, while gold remains 16% off its peak, the gap can signal investor conviction is already splitting. Historically, these crossovers often happen before mainstream analysts admit capital is rotating. Next, Durrett discusses why that crossover could become far more important than most investors expect.
So gold's going to go below 5,500. It already is at 48, but it'll be below 5,500 when this decoupling starts, and the stock market will be above it, and the stock market will go below 55, and gold will go above it. But that's just my kind of line in the sand. That's what I'm looking at as the place where the battle is won by gold is right around 5,500 on the S&P, and I think it'll happen this year.
This is exactly what I was going to ask you about gold in 2026, is how you see the price playing out in conjunction with everything else you've been talking about. So could potentially be this year that we get those new all-time highs in gold, and we see that transition happen with the S&P.
Yeah, absolutely. I think it'll happen this year. I think gold will hit an all-time high, possibly in June, and then have another deep correction all the way down to, we might even go all the way back to 4,100, but 4,100 looks like it probably will hold unless the Iran war gets worse. If it gets worse, then we might go back below it. Right now, it looks like 4,100 is going to be the low, but I think we'll go back down to 42 to 4,400. Even if we hit an all-time high, if we go to 5,600 again, I think we could crash all the way back down to sub 4,500. One more deep correction. But the one thing is, people need to realize is that gold is the asset to own. It's the buy the dip asset. It's going higher. So I don't care how much they try to push this thing down. They just tried to push it to 4,100 like 2 weeks ago, right? We're at 48.50. It went up $750 in a week. So good luck holding gold down. It's not going to happen. That's why I say you want to buy these dips, because gold is the buy the dip asset. The only way that gold's going to get pushed down and held down and kept down is if the U.S. economy comes roaring back to life. And I just gave you that long list of problems that we have to fix. I mean, good luck with that.
Yeah, good luck. And I want to talk about silver as well. I think previously you'd said, well, silver's along for the ride with gold.
Investors usually hear about new highs, but they rarely hear about the damage that can happen between those highs. As Don Durrett points out here, a move from 5,600 back toward 4,400 would shake out late buyers even inside a larger bull trend. That matters because many portfolios are built for smooth gains, not violent repricing tied to geopolitical risk or weakening growth. A $750 rebound can feel bullish, but it can also hide just how unstable underlying sentiment has become. Next, Don Durrett talks about whether silver can really keep pace if gold remains the safer trade.
So if gold is going higher, silver is going to follow. Does that still hold true if we have economic troubles? Because silver, of course, it's got its investment side, it's got its industrial side that could maybe potentially be hurt. So what are your thoughts there?
So gold is very easy to understand. 80% of gold is investing gold or jewelry, which is basically the same thing. And so gold's really easy to understand. It's just an asset, it's a store of value asset in the story. Simple story to understand. Silver is, I consider gold a man. It's ruled by the sun. It's very masculine. It's very stable. It's Leo is the astrological sign that ruled by the sun as well. It's also ruled by gold. Gold is the stable masculine sign. Silver is the feminine sign. It's ruled by the moon. The moon is always the maternal moon. It's always the feminine. You can't understand silver. It's very volatile.
The real difference between gold and silver is not price. It is investor behavior under pressure. As Don Durrett points out here, gold stays easier for institutions to model because nearly 80% of demand comes from wealth storage and jewelry rather than shifting industrial demand. Silver reacts to both fear and manufacturing cycles, which means recession headlines can distort it faster than fundamentals. That dual identity is why silver often confuses investors who expect it to mirror gold in a straight line. Next, Don Durrett unravels why silver's volatility can become both its biggest risk and its biggest opportunity.
And when you buy, you just don't know what's going to happen with silver. Silver right now, gold's down 16%. This is the thing that cracks me up, how you can't understand silver. Gold's down is 16% away from its all-time high. Guess, I'm going to let you guess because you won't even come close. Guess, you might get it. Guess what the percentage is that gold has to rise to get back to its all-time high. Gold only has to go up 16. So what do you think silver has to do?
Oh, to get back to the all-time high, 40%?
50.
Oh my goodness.
Yeah, it's at 79 right now. Call it 80. It's got to go to 120. It's got to rise 50% to get back to its all-time high. That's how volatile silver can be. So silver, you can't understand it. We don't know it up and down. When it runs, it really runs, right? It went from 35 to 65 in a few months, over 100% move. So silver, we don't understand. Silver has so many issues, if you will. One, not only is it an industrial metal that needs about 70% of its supply needs to be done by fabricators, but it's also a critical mineral. I mean, gold isn't even close to a critical mineral, right? Silver's a critical mineral. And there's not enough of it. If you look at above ground supplies, as a matter of fact, right now, the COMEX has like 80 million ounces in registered. 80 million. I mean, they're running out real fast. They're going to have to come up with some silver here this year. They're going to run out. I mean, If you look at the inventory levels, the LBMA and the Shanghai, those are the only three places where you can buy silver. And right now, over 200 million ounces a year is needed just for solar alone. And if you look at vehicles on top of that, you get to 300 million. All the vehicles, including airplanes, anything with a wheel on it basically needs silver. Anything, all your appliances, all your phones, they all use silver.
A metal needing a 50% rally just to revisit old highs tells you this is not a normal commodity story. As Don Durrett points out here, silver's price swings are disconnected from the tightening supply picture many investors never see. Registered COMEX inventories near 80 million ounces look thin against industrial demand that can exceed 200 million ounces from solar alone. That mismatch creates a market where headlines can look calm while the physical side grows more fragile. Next, Don Durrett discusses what happens if governments step into that imbalance.
So it's easy so we could run out of silver. Okay, if we run out of silver, then what? We don't know. It's uncertainty, right? What does the government do? Do they prevent us from buying silver? Do they tax it? What do they do? We don't know. There's lots of uncertainty around silver. And so in theory, silver should just absolutely go to the moon in theory, because there's not enough of it. And if gold goes higher, silver's going to follow, which I've been saying. I'm confident that silver will follow gold, but there will be periods. This is important. There will be periods when silver does stuff that we just shake our head and go, what the hell's going on? And what I mean that is that like silver could go to 150, 180, and then turn around and go all the way back down to $80 and stay there for 3 months. I mean, we could see crazy stuff like that. Now, why would silver do that? It would be because the government put some regulations on. But anything that the government does will be a one and done thing.
The market usually prices scarcity, but policy can interrupt that process without warning. As Don Durrett points out here, silver may not move in a clean line even if supply keeps tightening underneath the surface. Governments have a history of changing tax rules or market access when strategic materials become politically sensitive. That means a move toward 150 could still be followed by a brutal reset that has nothing to do with true demand. Next, Don Durrett shows why temporary intervention may not stop the larger silver trend for long.
They won't be able to do it permanently because it's global. It's global in nature. So anything like the West does, they can't put that pressure on China and India. China and India, they're going to keep buying silver, period. But the U.S. can try to control the inventory levels. One of the things I think the low-hanging fruit is they can empty the ETFs. And that's an easy one, but it's a one-and-done thing. Once they do it, then once that inventory's gone, then they can't do it a second time. And so people will, that's what I meant. They could push it to 80 for a few months, and then it would start going, and then it would start trending back, and then it would rip back to where it was at before. So you'd have to just be patient and wait for it to come back. But if you own silver miners, your silver miners could drop 50% in a week. And a lot of people can't handle that volatility. So the volatility in the miners is going to be silver is going to be very extreme, but ultimately it's going to go much higher. The key here is gold. Gold, it's how long this bull market, does it last 2 years, 3 years, 4 years? We don't know. I think it'll last at least 2 more years. And the longer that the bull market in gold lasts, the better for silver. It's very basic, very simple. So my targets are 7,000 gold and $200 silver. Now, why? So I think $7,000 gold, if you look at the technicals, if you look at history, I think 7,000 absolutely is a very achievable level. And I actually think we probably will go significantly north of that. But I think that's a very conservative target. I mean, we were just at 5,600, so 6,000 is just way too low, right? So I think 7,000 is a legitimate number right now. Now, if you use 1% of gold, that takes you to $70 silver. Well, that's way too low. 1% is just ridiculous.
The part most investors underestimate is how quickly paper markets can distort a real supply story. As Don Durrett points out here, ETF inventory can be used as a temporary pressure valve, but only once before physical scarcity starts showing again. A miner dropping 50% in a week can force emotional selling even when the long-term thesis remains intact. That is why volatility often transfers wealth from impatient holders to disciplined buyers who understand the cycle. Next, Durrett talks about how he calculates silver targets without relying on the usual industry narratives.
We were at 3.5 in 2011. So if you go 2%, it's 140. And if you do 3%, it's 210. So I think it'll be somewhere between 2 and 3, and it could go to 4, which would be 280. But I think it'll be somewhere between 170 and 200 is kind of where I think it'll go. But it'll probably overshoot that and then come back down in that range. And then we could see periods of significant corrections that are much, much lower than those levels. I think it'll stay above 1%, but definitely. So that's kind of where I'm at with silver, a kind of a $200 target. I plan to sell all my miners somewhere between $6,800 gold and $7,800 gold. I do not expect to own any miners at $8,000 gold. And the reason why is two reasons. One, I got in early so I can leave early. And the second one is you don't want to sell tops. You don't want to wait for tops because you just don't know when they're going to come. And when they come fast and furious. So, at $7,200, $7,300 gold, I'll have sold probably half of my stuff.
Price targets matter less than knowing when your own discipline begins to break down. As Durrett points out here, the real strategy is not predicting the exact top, but managing exits before momentum turns against you. Investors often chase the final 10% of a move and end up surrendering 30% on the reversal. A projected silver range of 170 to 200 sounds compelling, but portfolio survival depends on execution more than optimism. Next, Durrett discusses what larger geopolitical shifts may be driving these metals beyond technical patterns alone.
I firmly believe that the reason gold took off in February 24. So in February 24, gold was at $2,000, and then it just took off. And the reason why I believe it took off is because of the Ukraine war that started 2 years, February, March before that. So it basically took 2 years, and that war didn't end. And so that war created geopolitical friction that was already building. We already had this economic Cold War between the US and China. And it's basically, a battle over who kind of controls the global international trade and the currencies and the interest rates. And the US has been in a dominant position since the end of World War II, where we've been exporting our bonds to the rest of the world. And the rest of the world's been buying them and turning around and buying our debt, buying our assets, buying stocks and bonds and companies and whatever, rotating money back in. So we've been dependent on that rotation, that flow, if you will. American consumers will buy your goods, then you buy our debt, and it flows around. Well, that war kind of signaled the end of that. And so it created a lot of uncertainty. And so we got 2 years, the war didn't end. And so since the war didn't end, the SWIFT system that's how international trade, commerce, that's how all of transactions were done, through the SWIFT system, which is only using the US dollar. And the whole world was using that system. And suddenly Russia was kicked out of that system. And I think when Russia got kicked out of the system, China recognized an opportunity to create an alternative system to SWIFT, which I think they wanted. They're like, oh, this is our opportunity. Normally, China and Russia should be antagonistic towards each other because they're both in the same area of the world, in Asia, and you can only usually have one dominant player. So they're like natural enemies. And India is an up-and-comer as well. They're a very large country. As a matter of fact, demographics show that India is going to have a bigger population than China very soon. So India is a player.
Markets often pretend gold moves only on inflation, when geopolitics is quietly doing the heavier lifting. As Don Durrett points out here, gold's move from $2,000 after February 2024 lined up with a deeper fracture in the global financial order. When reserve systems start being questioned, investors begin reassessing what safety actually means beyond treasury paper. The media still frames these moves as temporary fear trades, even while currency influence is becoming a strategic battlefield. Next, Don Durrett unravels why bond market fragility may be the signal investors should watch most closely.
And so they're antagonistic. So you have these three antagonists who all of a sudden became friends because of the war in Ukraine. And that created a situation where the US bond market suddenly became a little bit fragile because we're starting to lose our customers. We're starting to lose kind of the status quo. The status quo started to break down. And I believe that's the reason why gold started going up in 24. And it's been basically going up nonstop. And this is where I say that the bond market is so important to gold. And this is why I say the only reason I own gold and silver mining stocks is because I believe that the US bond market is going to fail. Now, I don't need it to fail for the gold and silver mining stocks and for gold and silver to go up. All I need is for it to become fragile. And once it becomes fragile, then people start to become a little nervous. They're like, I don't want to own these bonds. I don't want to buy these bonds.
Gold can rise long before a financial system actually breaks because confidence usually cracks first. As Don Durrett points out here, the bond market does not need to collapse to change investor behavior. It only needs to feel less dependable. Foreign demand has supported US debt for decades, but even a small shift in that trust can redirect massive capital flows. That subtle transition is often missed because headlines focus only on dramatic crashes instead of slow structural erosion. Next, Don Durrett talks about why rising interest costs may make that fragility harder to contain.
I'm going to sell these bonds. And I think that is the era we're heading into right now, is fragility in the bond market. All it's going to take is a recession in the US, which I think is coming. We can talk about that. But I think gold in the bond market is really, that relationship is the key to it all. And that's the reason I own gold and silver mining stocks, because I just feel that we're in an untenable situation. Everything was working fine until a few years ago, and then the U.S. debt problem it started growing to a point where it becomes untenable. Where now, the weakness in our system is interest rates. As long as interest rates were down at 1%, we were okay. We had like $200 billion interest payment, which was, we could handle that. Now it's at $1 trillion. And interest rates aren't going down, and we can't cut the budget. If Doge cut it by $200 billion, and it was a joke, right? It was like, that didn't do anything. It was like, did that reduce the deficit? No, it didn't. And then now Doge went away, and now we're back to 2 trillion. So they tried and they failed, and I don't think there's any solution here.
The bigger risk may not be recession itself, but what higher rates are already doing to the federal balance sheet. As Don Durrett points out here, annual interest costs rising from roughly $200 billion to $1 trillion changes the math behind every policy promise. Investors who only watch CPI or payroll data can miss how debt servicing slowly becomes its own market event. Once confidence in fiscal control weakens, defensive assets can reprice faster than most portfolios are prepared for.